Growing up in a wealthy household, some of the family members go into habits that aren't the greatest, drinking, drugs, etc. So they go down a wrong path that leads to issues for the overall family. Money has no friends or family. Like, there's no bloodline with money. Incredible how black or white financials become when things go awry. When there's business conflicts, you see the worst of people. And that could be your own siblings, and it could be your own family. I mean, you see the worst of people.
Okay, welcome back to the Rabasha Family Podcast. We have a very special series within the Family Office series, and I'll be hosting it with Shuvam. And Shuvam is head of Family Office and Capital Markets. He's a strategic wealth architect of high net worth families, private equity, real estate, tax optimization, passive income planning. He's been able to lead a multi-family office advisory firm with a singular mission to help high net worth individuals and families turn complexity into clarity and capital into generational wealth. His clients are business owners, executives, entrepreneurs who want just more than off-the-shelf strategies. They want access, precision, results. He's been able to deliver all three of all those through curated private equity and credit opportunities, tax advantage structures, and customized wealth roadmaps. And obviously your specialties within the private equity, tax optimization, alternate investment structuring, passive income roadmaps, investment policy statements, and family office strategy. So with this podcast, we want to be able to build something that lasts longer than a market cycle to help families, help people understand, the problems that wealthy families go through. So Shuvam, it's a pleasure to kick off this series with you and have these amazing conversations with family office people from all over the world. And we start off with just us having an awesome conversation today.
Yeah, no, I'm looking forward to it. And thank you for having me on.
No worries. Just a quick what's happening around the world right now. When something like this happens, right, we see what's happening with the US and Iran. Does anything like this affect your business or your clients? That's actually a very interesting.
Marketing is all about storytelling. Dad, when we first started this business, what did you say to me?
I said, yes, we do a podcast.
Why?
Because I want to tell our story.
Why?
Because I know the story builds a legacy.
Builds a legacy. And that is exactly what we do here at ETS Rabasha Media. We market your story on social media so you could build a legacy for those who come after you, to build your business and your personal brand.
Yeah, follow us on our platform. Go on our website, etsrabashamedia.com.
This is about legacy, and it is about showing up on social media every single day, because if you don't show up, your competition will.
Yeah, not necessarily direct effect, but you definitely have to keep cognizant of what's happening around the world. A lot of our clients are business owners, have business overseas, Middle East, Europe, and things like that. So you have to keep eyes on what's happening. And this is where the investment policy statement really makes a lot of sense to have one, right? It's a foundation. From a geopolitical perspective, you always have to keep an eye on what's happening because it affects commodity prices, which affects businesses, right? From costs and things like that. Obviously labor as well. People are having a tough time now getting out of the Middle East and things like that. So there's no direct effect. It's an indirect effect in certain areas.
Okay, and just quickly, can you explain what is an investment policy statement?
Yeah, so investment policy statement is the start of the whole process when we work with families. And essentially, it's a document, as I compare it to a foundation of a house. You lay the foundation first. The investment policy statement is the foundation of the financial house. We talk about investments, right? Where you are situated today, where do you want to be, but also other things in your life. Legacy planning, if you have kids, philanthropy, what do you want to do, to keep your legacy and things like that going. If you have many businesses, entity management, how do we structure that properly? Tax strategy work, making sure that you're structured there. Insurance strategy work from a protection standpoint. Estate planning as well, to make sure that you have the right entities and the right domiciles to make sure that you're protected. God forbid something were to happen to you from creditors and stuff like that. So it's It's a broad document that covers a lot of topics. It's always changing over time as families' needs changes and wants changes. But again, it's the foundation of a family's financial life.
So, like, with this series touching on the kind of the pain points that families go through dealing with such substantial amount of wealth, and also on ways on, growing and multiplying wealth, how do you navigate uncertainty like we see, for example, there's something like this? Who would have predicted this? Who would have predicted COVID, right? Even this thing, US, Iran, who, like, the amount of impact that's had on businesses now is unbelievable, right? So that can happen to any one of us. So how do you navigate that for your clients, these family offices, where, yeah, how does that process work?
Yeah, I think the biggest thing for us, it's not shifting the course, right? I think that's kind of the initial reaction for most people is, as you mentioned, COVID, geopolitical conflicts, you want to do something drastic, okay? Sometimes doing nothing is the best thing and seeing what is actually going to happen, right? COVID is a great example of that. 2020, when COVID really hit the market from an economic standpoint, everything was shut down, right? Markets tanked, economies tanked, GDPs tanked. But if you stayed the course, 2021, it rebounded. I mean, almost double than what the actual loss was. So it's hard. That's why families work with us, because we act as their emotional chief investment officer as well, right? We take the emotions out of it and we go back to the IPS to make sure that we're managing their assets in a way that, regardless of what's happening outside, we're going to stay that course. But it's hard. Financials is still emotional, and it's hard to ignore what's happening today with Iran and how that affects the markets and things like that. You have to keep that in the back of your head. But making sudden changes or decisions is probably not the best thing to do.
Yeah, like you said, kind of just waiting and see how things play out. And, like, from your experience working with wealthy families, what are some of the biggest challenges that a lot of people don't see from the outside? That, when people just think you come from a wealthy family, it's a wealthy family, they just think, oh, whoop de doo, you have all this money
Yeah.
and life's great. What are some of the
Yeah.
challenges that you see personally that other people may not see on the outside?
Yeah, I mean, wealthy families, they have, I don't want to call them problems because it sounds weird to say it that way, right? Compared to people that are maybe not at that financial level. Wealthy families have different challenges. Okay, that could be internal within their family if they have kids, how to navigate that with their children, their wealth. Wealth can be a blessing and a curse at the same time. Okay, so there's internal challenges. Then there's external challenges, right? What are those external challenges? It could be from business perspective, right? You always have to keep growing. If you have payroll, you have all these other employees that are counting on you to make sure that you are, meeting those payrolls and things like that. So there's a financial challenge that comes with that. There's reputational challenge, right? That also comes with being wealthy. Obviously, most wealthy families want to be very efficient with their taxes. So how do they structure that in a way that will optimize their overall family office from a tax perspective? Talked a little bit about insurance, right? Making sure that they're protected on the protection side, as well as utilizing insurance as an asset class for potential investments. So it's just more complex, to sum it up. They have more complexity than a normal family that, maybe not at the wealth that some of these other families are.
So, like, for example, with, like, a wealthy family, when they come to you, before they come to you, what's their issue? Why are they coming to you? What's their
Mhm.
pain that they're saying, oh, I need to speak with Shuvam?
Yeah, the biggest reason why families come to us is organizing their life. That's really the biggest reason, right? Putting it into a concise place where they could get a good dashboard and snapshot to see, okay, I have X here, I have Y here, I have Z here, right? That's the biggest reason why they come to us. We've utilized many technologies to help these families, which they've loved. Obviously, AI today helps a lot of that, but That's the main reason why they come to us. Then when we start peeling back the onion, talking about tax strategy and insurance strategy and estate planning strategy and all that, then that's where we show our value, right? Talking about how we can structure them in a way where it creates more efficiencies, not just today for them, but down the road.
Down the
And
road
then
as well.
investments, just one more piece I'll add to that. People think that we do a lot of investments, and we do, but investments is the last piece of the conversation. That maybe is a 20 to 30% of it. Wealthy folks, as I always say, my job is not to make them rich twice. They're already wealthy. My job is to keep what they have, grow it incrementally, but more so grow it efficiently, but also protect them is the biggest thing, right? We hear a lot of in the media of, many different walks of life, profession wise, of how they've made this amount of money and then they lost it all. Okay, gone bankrupt. The main reason for that is because they never structured themselves right. Okay, it's not because they made bad investments. It is that's part of it, but they just didn't structure the investments in a way that was going to grow their net worth. And then lastly, what I'll say is my job is to protect them from them. Okay, and what I mean by that is a lot of wealthy families are getting pitched many different investments. Okay, and I say no to a lot of investments. And being now their CIO, Chief Investment Officer, it's my job to vet all those opportunities out. And like I said, 9 out of 10 will never make their portfolio. Okay, and times before that when families are not working with us, they would invest into this, they would invest into that, and thinking that the pro formas that they're being shown, they're going to hit on every single one. Well, after a while, when you're losing money here, losing money there, it starts adding up after a while. So that's another reason on the investment portfolio why they want to work with us, is that we take the onus off of them and the emotions off of them as well.
You said 9 out of 10 you say no to. Why do you say no to those, and what makes you say yes to one? And because it's a huge responsibility for you, I can imagine, as a chief investment officer, for example. I know you talked about the protecting side of things. Fair enough, that's great. But also, let's say maybe in terms of that investment side, to maybe a family says, okay, how can we grow? Yeah, what makes you say yes to a deal? Why do you say no to most deals? And what type of responsibility do you feel? What's your kind of mission and vision being the CIO, and having such a responsibility? I know there's many questions in there.
Yeah. Yeah, so let me answer the last question first. So the responsibility that I and we feel is tremendous. We have to make sure that we're getting it right majority of the time. We're going to make mistakes. We're human. We're going to look at things wrong. Markets may change on us, right? No one predicted COVID. I don't want to say no one predicted the geopolitical issues that we live in today. Some maybe have predicted that, but in general, right? Like there's things that are out of a lot of people's control. So, but we do feel a lot of responsibility in our due diligence. How do we say yes to a deal? I'll start there and then I'll work. It's easy to understand the no. One, it's got to fit in their buy box, which is created in the investment policy statement. Okay, that's the easiest one. And then when it does, that doesn't mean that it's automatically going in the portfolio. The second stage of that due diligence is manager make understanding who the managers are, the operating partners, the general partners, wherever, however they're structured, making sure that they have the track record, they have the expertise, there's no issues with them on an individual level, things like that. Then is obviously the investment itself, right? The pro forma, the underwriting, making sure that everything that they're saying that they're going to do or projected that they're going to do, I try to cut it by 50%. And if I'm happy with that return profile, then I'll continue to move forward in the due diligence. And then the last few steps in the diligence is more legal work, right? We get their documents, we go through that. AI is actually fantastic now with reviewing legal documents as well, very quickly on keywords and all of that. So we utilize that as well. So that's how we say yes. The no, majority of the time is a very easy no because it won't fit in their buy box. Okay, there's a lot of real estate deals out there today. There's a lot of venture capital and private equity deals out there today. There's a lot of firms looking to raise capital. And I'm not saying all of them are bad, but if it's not fitting in the buy box of the family, it's an automatic no. Okay. I don't also say this. I also disregard if the family wants to move forward with it. I'll give them my thoughts and I'll give them my strongly memoed opinion as well, saying this is not going to be a fit for you. At the ultimate, it's their money. So if they want to continue to move forward, it's going to be at their discretion. Majority of the time, the families will rely on my decision on moving forward or not. But there has been certain instances where families want to do a certain investment or buy something that I definitely don't think it's the right move. And we have a little bit of a contested conversation, I'll put it that way. And they eventually realize that I'm looking out for their best interest and they shy away from it.
Yeah, we actually have a question from our audience, but before I go on to that question, you said something. You said when you do say yes, you cut out what they say they're going to do by 50%. Can you?
Yeah, so the pro forma, right? Every investment has an underwriting or a pro forma that they're going to give to you, right? And they're giving you a lot of best case scenarios, okay? And they'll even tell you, right, this is conservative. I've heard that word all the time. The reality is they're giving you a lot of best case scenarios. So what I do is I cut it in half. Everything that they're projecting to me, I cut it by 50%. And if I'm happy with that 50% return, so if they're saying at the pro forma level, they're going to do an 18% IRR. Okay, so I'll cut that in half and I'll say 9. Am I happy with the 9% IRR in this asset class? Okay, if the answer is yes, then I'll continue to move forward. Okay, if the answer is no, then I won't. It's really that simple because there's a lot of investments out there. Okay, I can't continue. I need to have a process to vet out investments on a fairly quick fashion instead of doing a deep dive into every single one, right? So those are my quick litmus tests, right? Cut it in half. If I'm okay with the 50% return profile, then I'll move forward down the line of diligence.
So, for example, I'm working with a CEO founder. She sent her pitch deck and said, like you said, they press projections, right? So it's 20 million ARR. So if I was a CIO, I would look at from what you just tell me. I would look at 10 million, like
Correct.
half. Okay, and
Yeah.
then am I happy with that? Okay, very
Yeah.
interesting.
Because the reality is everything's not going to go according to plan.
Correct.
Right? In any deal that you're going to look at. I mean, sometimes people get lucky and everything checks the boxes right away. Those are such unicorns in the investment world. Majority of the time, things don't go according to plan, but how do you adjust, right? So that's the other thing that we do in our due diligence on the managers is that one of the questions I ask them in the beginning, as they're pitching me their deal, they're talking about their incredible track record, I stop them and say, tell me about your bad deals. How did you manage those bad deals for your clients and your families or wherever your investors are? How did you manage that? Okay. And if I could get comfortable and get a better understanding of how they manage those bad deals, the good is the good. That's easy to understand, right? Everyone is a hero when the markets are going higher, right? You kind of get the litmus test when markets are choppy and investments are not working out.
And our question from the audience is maybe a vague or general question, but what are some of the best investments to make? And that's from YouTube. What are some of the best investments to make in your opinion?
I mean, that's a very broad question. It really depends on what asset class. Over time, you can never go wrong with real estate. Obviously, private credit is a big investment thesis today that's showing some signs of, rough waters right now. But I think over time, you'll be okay in private credit. Yeah, it's a very tough question to answer. But I guess one of the things that I would say is understand what your buy box is and also understand what your goal is that you're looking to achieve. Okay. If your goal is trying to make $100 into $200, well, gamble on the stock market or go to the casino, right? But if you want to grow $100 incrementally over time, real estate is probably the best way. And I would always start off smaller, rather than larger in any investment that you do. Why? Because you'll get your feet wet, and this always is going to happen. It's Murphy's Law. The small investment is probably going to work out incredibly well, and you're probably going to wish you invested more money into that deal. That's how it always goes. But again, stay that course, right? Start small. And when you have discretionary funds, just keep adding and keep adding slowly. It's not a sprint. The investment game, the investment world is not a sprint. These families that have built incredible net worths, yes, some have done it in a short period of time. Some have gotten a little bit of luck, but majority have built it over periods of time, right? We only see the output and the end, quote unquote, result of that hard work. But we see this in the venture world and startup world, right? We see like, oh, this company's valued at $1 billion today. Well, no one was around when the company was valued at 10 million and having a hard time making payroll, right? So he should get or she should get all the accolades now. So starting off small in the investment world as a passive investor is the way to go, and just keep compounding those returns.
Great advice. What is private credit? Like, what is that for the people who don't know? What is that, and
Sure.
how is that an investment?
Yeah, so simple terms of private credit is just, you're investing into private markets where you're essentially like acting as a bank. Okay. Real estate is obviously the biggest market for private credit, where there's been funds that have been set up where real estate developers or operators have had a tough time in getting traditional bank loans. So they go to some of these private credit funds or investment vehicles to borrow money. And then you, as an investor, will get a return, a fixed return on that money. Okay. That's a simple way. But there's real estate, there's all different types of sectors have private credit in them. In the automotive sector, businesses have private credit. There's all different types of sectors, but essentially it's just private money being lent. That's it.
Being lent. I love it.
Yeah.
And we see like money can strengthen families, but also divide them. What is some common conflict that you've seen with wealthy families?
Where do I start with that? Because I've seen a lot of it. The biggest one is the main thing, the money. Um, you know, Money, like I said before, it's a blessing and a curse at the same time. When it's a curse is when you have family members that don't have the same values and vision of the family itself. And that could be to many reasons. Unfortunately, growing up in a wealthy household, some of the family members go into habits that aren't the greatest, drinking, drugs, etc. So they go down a wrong path that leads to issues for the overall family. So that's one. The other thing could be business, right? When there's conflicts. The one thing I've realized with money is money has no friends or family. Like there's no bloodline with money. Like it is incredible how black or white financials become when things go awry. And it's sad in a lot of ways. I can never say I understand it because my personal family is not like that, but I've seen it. So when there's business conflicts, you see the worst of people. And that could be your own siblings, and it could be your own family. I mean, you see the worst of people. So it's personal conflicts, business conflicts are the main two issues that come up where that creates a little bit of divide amongst wealthy families.
So how does one deal with that? Let's say if I'm leading the family, we've built a family business. Maybe there's two people in our family. We're organizing and doing this, but then you have someone else within the family who, I don't want to say the word liability in a bad way, but like who's potential
Yeah,
liability. How does one deal with that? Do you know? We've built up this family business. Are we just gonna have freeloaders? Are we just going to be giving money to people? Should we, we have a system within the family where people are earning what they're doing? How do you
yeah,
deal with those habits or people who haven't reached that maturity in the family to understand the
yeah.
mission and the vision of the family?
Yeah, and this goes back to the IPS, right? Even though the word investment is in the statement of investment policy statement, investment is not always financial, right? It's also family related. I think every wealthy family should create family charters, okay, that lays out what members should be doing, okay, as they're growing older. Okay, so if you have a 10-year-old son or daughter, you should have at a certain age that they need to, that this is going to be their responsibility within the family. Okay, it may not be within the family business, it could be just within the family itself. Okay, so every family should have a family charter. We create those within the investment policy statement for certain families. The family legacy, right? That's part of this family charter, is that what type of legacy does the family want? Where I've seen that there's been certain family members that have not been included in the family legacy and the family charter for reasons that I won't talk about here, but I think we could figure them out, right? That they view that family member that this is not going to be conducive to their growth of their family. They still love them. They're still going to be treated as a family member, but when it comes to the finances of it, they're going to be kind of separated out. Okay. And those families handle it in a very different way, where they'll set a money aside and they'll create a trust for that individual. So it's not like they're going to kick her out, and say, screw you, you figure it out yourself. That's not what's happening. But they'll set a certain portion of their assets aside mainly for them. The other thing is health. Okay. Health things come up, sicknesses and all of that, that are out of people's control. This doesn't create conflict, but it more so creates how should we utilize our family wealth to take care of loved ones, right? Do we look, and this is where I was talking about insurance, right? Not only from an asset protection standpoint, from a health protection standpoint, right? So do you get long-term care insurance for aging family members and aging parents, et cetera, aging grandparents? Those are the things that we talk about within this investment policy statement.
And like, how is it for you as a, like, being a chief investment officer, when families may come to you with those problems, because you're not directly in the family, but it's quite emotional. How is it for you? I can see yourself even getting involved in it a little bit as well, because these are your clients, but they also become family
They
to you.
do.
So how do you
Yeah.
kind of keep that logic and
Yeah, I try to keep the emotions out of it as best as I can. But you're right. When you work with these families, yes, there's a business relationship I have with them. But a lot of my families came to my wedding, right? They're part of my family in an extended way. And I ingrained myself within them. Hence why our tagline is of our family office is welcome to the family, right? So we integrate. But with that said, I still understand my role, right? And my role is to be the clear minded, non emotional voice in the room, okay? That is not attached to one side or the other, or this investment or that investment. It's just making what is the right decision. So when, you know, conversations like this happen, there's a little switch in my head that goes off that says, okay, I have to really go down a path of what is the best for the family, not what's best for one specific individual. Okay. Because at the end of the day, my role is the CIO for the family office, not for this specific person within the family. So I try to take that path and try to keep that straight path as best as I can. I do get involved a lot in conflict resolution, where I become almost like a psychotherapist in a lot of these meetings and controlling family members going at one another. But that's few and far apart. And again, I try to be the cool headed person in the room and make the best decision for the family office, not necessarily the best decision for family members.
because the family members can even be the ones who, like, let's say I come to you to engage for our family office, but you're not serving me. Your duty is in the family
Correct.
and the
Yeah.
family.
My fiduciary duty is to the family office. Okay. My fiduciary duty is not to a specific family member per se. Now, don't get me wrong. I've had family members call me and say, "Hey, I want to do this, I want to do that," where I've said, "No, we can't," because my fiduciary duty is to the family office. Okay. So it's It's a role that I don't take very lightly. And it's hard because you become friends with these families and no one wants to say no to anybody, right? But that's why they have me.
And we often hear that wealth disappears within 3 generations. There's that famous saying. Why
Yeah.
does that happen so often? Why even like the fact that that's a statistic? It's like a
Yeah.
phrase. Why?
I think that happens for many reasons, but the biggest reason is they just didn't structure their assets correctly from an estate planning perspective. That's the biggest reason. Taxes eat most of their assets as it goes from generation to generation. Yeah, a part of it is due to family members not wanting to be in the business. There's conflicts within families as well. But a majority of why wealth dissipates when it gets to generation 3, generation 4 is because they just didn't plan right. And, we talked about this in our first podcast together, why the Rockefellers, they created the Rockefeller banking method essentially, right? They didn't create it, but they used the insurance model of infinite banking to keep passing down wealth from generation to generation as one generation passes away. Death benefit comes from the policy down to the next generation. It's a tax-free structure down to the next generation. That's how the wealth keeps distributing from generation to generation. Other wealthy families that we will recognize in the world, some of them didn't do that, and hence why there's certain generations today, it could be fourth, fifth, sixth, seventh generations where you would not you would think that they're very wealthy, but they're not because they just didn't plan right. So it all goes back to planning, and goes back to the theme of just because you have a lot of money, that doesn't mean you're set. Yeah, you could be financially set, but if you don't structure it correctly, the government takes it, unfortunately. So you got to protect yourself from that.
Yeah, yeah. And we actually have another question from the audience. Do you find that some next generation members, like especially the new generation that are coming, or are you hearing from their parents, for example, your clients, just in general? Do you think that some of them struggle with purpose when like the financial survival is no longer a motivation? The families, well off.
Yeah.
Yeah.
Yeah, yes. The short answer is yes. I think the biggest thing that the matriarch and patriarch of families need to do is educate their family members of the fortunate situations that they're in, but what type of value system, what type of legacy, all of those things that we were discussing earlier, like how do you want to lead the family moving forward? Okay. Yeah, you get the coin term trust fund kid, right? You get a lot of those, okay, where they go out and they're just buying materialistic things. I don't have a problem with that, if personally, I really don't, because their normal is different from the average normal. Okay, so you and I go to a restaurant, we're spending X. Their restaurants could be Michelin star restaurants where it's normal to them, right? Because that's how they grew up. So everyone has a different upbringing. But with that said, I think the one theme that every family should talk about, no matter what wealth, bracket you're in, is teaching their kids about financial literacy, wealth. I mean, I know you had a guest on your show where her kids were in meetings at a very young age, right? And that's great. They may not be comprehending anything, but the fact that they're there and over time they're going to learn about money and what to do, what not to do, what to look out for, how do you want to create that values, right, within the family. I think that's very important, right? Again, money is a blessing and a curse at the same time. I continue to say that.
It's a blessing and a curse at the same time. So it's very interesting. Do you as a family take it as a blessing, or does it affect you guys as a curse? And
Yeah.
for entrepreneurs and families currently building wealth, what should they be doing today to ensure that that lasts a generation? Like, what can they be doing? I did like what you said, for example, even just that last one of the family educating them, having kids in the meeting like I had in that interview. So yeah,
Yeah.
what would you say on that?
Yeah, I mean, education is paramount. Creating financial literacy for the kids is paramount. Showing the kids where assets are within the family. Like I never understood families that don't show their wealth to the kids. I don't get that, right? Because you're building something for them. So why won't you show them now, right? If you think that they're ready, why won't you show them today to make sure that they're going to be good stewards of that capital when you pass on? Right? Because that's one thing that's going to come for all of us is we're going to die. So how do you want to leave that legacy? Well, when we're not here, your kids who, if you never taught them how to continue the legacy on, what are they going to do with that? Do they become the materialistic and just buy stuff, or do they, try to create the values, continue the value system and the legacy that you hope that they did? So that's why the education very early on is important, coupled with showing them this is where we're at today, having them in meetings with your financial advisors, wherever your advisor team is. We do that a lot with our family offices, with their children and stuff. And listen, if you have young kids, they're not going to comprehend any of that stuff. But the fact that they're there, maybe paying attention to a degree is great. But I think getting them early on in the meetings and teaching them as much as you can is only going to help you and them in the long run.
Powerful, powerful. And as we wrap up like this series, as we're going to be having these conversations, why did you want to do these series? Because I know we came together and it was a fantastic idea to talk to family offices all around the world, Australia, everywhere,
Yeah.
US. Why did you want to do this? What's the vision that you have for
Yeah.
just opening these discussions with family offices around the world, and also families who are sitting on such substantial wealth and building in real time?
The main reason is I wanted to learn. That's really the crux of it. What I've realized in the wealthy family world, one, many people built their wealth in many different ways. So just a curiosity of mine of how they did that. And then number two was, what are their pain points, right? Because we think all these wealthy families, man, they're just waking up, it's sunny every single day, they have no struggles or any of that stuff. But that's the furthest thing from reality, right? They have different types of challenges every single day. So I wanted to understand that more. And then within our own family office, we have pain points. So how are families navigating that? So I wanted to learn from them of their challenges that they might have encountered, and how could I learn from them? It's really, I wanted to do this because I wanted to learn as much as I can, because I don't definitely know it all, right? I think I know enough to be somewhat dangerous, but there's much bigger family offices in the world, much bigger families with significant net worth in the world, that I want to understand from them of, okay, when they faced something that I like couldn't figure out, and if they faced the same thing, how did they navigate that, right? That was really why I wanted to do this.
Cool. And I can't wait for us to continue to have these powerful conversations around the pain
Yeah.
points, around how people build wealth, that as you lead the show. So it's a pleasure to have you on. Just real quickly, we'll play a small game that we played before. When I say a certain word, what comes to your mind? Chief Investment Officer. What comes to your mind when I say that?
Steward. I'm trying to be a chief investment officer's, I feel, main role is to be a good steward of their capital, coupled with fiduciary. So I'll use two words with it, but main is to be a good steward of their capital.
Real estate.
Asset protection is the phrase that comes to mind. We'll use another word too. It can build wealth as well. So another phrase, but asset protection mainly.
When you look at a real estate deal, what lights up your eyes when you see a good deal that can have a good return? Is there any certain deals that can even bring in, like, for example, cash flow right away, capital appreciation? What's one thing as a CIO when you see, oh, that looks like a good deal in terms of real estate?
I think before even the deal is who the operator is. That's when you're investing into real estate, it could be the greatest deal on the planet. And if you have a bad operator, you're going to lose money.
What do you
That's
mean by
just
the operator? Who's the operator in that situation?
so typically most like us, we invest with other operators, right? We're passive investors into their investment that they brought to us. So they're managing the deal. They're the general partner slash operating partner, right? Whatever terminology you want to use. And that's why I vet them out, number one, as much as I can, right? There's going to be bad actors out there that you could do all the due diligence in the world that's going to pull something over your eye. But in general, we try to vet them out. So you could have the greatest real estate deal that could pencil and pen to every return profile that you want. And if you have a bad operator, you're going to lose money. It's really that simple, okay? So to answer your question of if the operator checks out, then it's location and what's the asset class, okay? Is it small multifamily? Is it large multifamily? Is it development? We per se don't do a lot of development deals. We don't do a lot of large multifamily deals. I like to do multifamily deals in very sleepy markets. And what I mean by that is there's not a lot of investors that are attracted to these markets. So everyone is chasing kind of the same deal. I try to be in very sleepier markets where it's insulated by a bigger metro market, right? So that's kind of the way I look at the real estate world. And, to answer your question, when I see a deal, those are the things that stand out to me.
Why don't you do developments?
I'm not saying that they're bad. It's just most of the time it just doesn't fit our family's profile because the returns are so drawn out. It's typically a 3 to 5 year hold on the low end. Most of the time today it's close to 7 years. And then coupled with the risk that you're taking, you could kind of get the same return today in existing multifamily. I think that's what a lot of people forget, investors forget, is that you're investing to get money back, right? It's a return. So if it's in a new development deal or if it's an existing multifamily deal, other than there could be a personal relationship with those operating partners, why does the investor care where the return is coming from? So I like to de-risk it as much as I can into an existing multifamily, right? That's already built. There could be a story of why this asset is where it is. In the last few years, there's been many of that because the debt markets have created a lot of opportunities in the existing multifamily space that has been built in the last 6 to 7 years. But again, investors always have to remember is that you're investing for a return. Okay. And if it's in development or if it's in existing multifamily, you have to look at where am I going to cash flow sooner? And most of the time it's going to be an existing multifamily.
Existing. But with the development, are you also counting on, okay, if I get it at this price now, by the time it's done, it's going to be higher appreciation more than the one that's ready, and then if that one, once it's ready, can produce cash flow, does that come into play, or you're just like, look, whatever brings?
Yeah, I mean, I'm gonna answer that question general, and I'll answer two parts. One, our family office, but in general first. In general, yes. In an ideal world, everything you just stated, that's what can happen, and perhaps should happen. But we don't live in an ideal world. No one predicted COVID. You go down to southern U.S. today. I'm based in Boston, but you go down to southern U.S. today. There's a lot of multifamily buildings that people thought were going to be the next greatest investment that are just sitting idle today. Why? Because markets changed. No fault to the developer. The debt markets changed for the developers, right? They were developing these buildings and the investors, unfortunately, lost money. But when they were sold the investment, they had the pretense that they're going to do really well. Real estate, I think the return profiles that were happening in the low interest rate environment were just unsustainable, where people thought that getting mid 20% IRRs was the norm. That's not real estate. Real estate should be slow and steady, right? Passive income from generations to generations, right? Slow and steady, just passive. Mid-teen IRRs is probably the norm for real estate, not the low 20s or mid 20s or high 20s that were being shown in the early 2000s. So, yeah, going back to what you're saying is that, in an ideal world, yes, that's the way it's done. But existing multifamily today, it's kind of easier to understand. Here's a cash flow. If you do a little bit of touch-ups or fix-ups of units, you could raise rent from X to Y. Then it's a math. It's easy to understand the math, okay? If I'm able to stabilize the building to 90% with rent growth of, call it 15% year over year, well, then it becomes a math problem, right? And that's easier to understand for most.
You said something quickly. You said like 20 years ago, something like the IRA, it was like the yield was about 20%. It was high. Was that because it was back then?
No. No, that not 20 years ago. A few in the last 6, 7 years, because of the low interest rate environment. So a lot of developers were getting low interest rate debt, right? Floating rate debt, as they termed it. They were getting low interest rate debt, and they were trying to develop these projects. IRR projections were in the low to mid 20%, sometimes high 20% IRRs, which is just not normal for real estate. And they never had in their vision that the debt markets were going to change because of COVID, right? Which, interest rates went up over 1,000 basis points in less than 8, 9 months. No one predicted that. Okay. And the developers with the low interest rate debt, floating rate debt, all of a sudden their debt repriced. And now the project that was priced at 2 to 3 to 4% debt is now being repriced at 8, 9, 10% debt. It's unsustainable. Hence why a lot of these buildings, developments were given back to the bank. Okay. And unfortunately, investors lost their money. So, yeah.
Powerful. And then the last bit I'll ask you, because I can ask 1,000 questions.
Yeah.
Family.
I mean, many words come with family, but I think the one that just stood out is bond. Family depends. Family may not be blood as well, right? I just want to caveat that. Family could be, your closest friends and things like that. But yeah, it's a bond. That's what family should be. And again, not saying it's only blood related, but yeah, family is what you have. When things are good, right, they're going to be your biggest supporters. When things are bad, they're going to be your biggest supporters, right? So it's a rare thing for people to have a good family. And I say rare because we see the news around the world today, right, where it's just not great. And, your North Star and your rock should be who's at home and who you have in your family. That's going to be the biggest change.
Awesome. Okay, Shuvam, I want to really thank you so much for your time today. I'm looking
Yeah.
forward to more of the conversations that we're going to be having, as we bring on more guests with us. And yeah, keep having these awesome conversations and helping just even the ones who are coming up today, the young generation, to understand these things that you're talking about. If we can teach people now, this information is accessible now, right? Maybe, we couldn't do this 20 years ago. Even you yourself wouldn't have had a platform to be able to say things like this, but now we can do that. So now this information is accessible to so many more people. So I think for us to come and educate and ask someone like you, and the experience that you have is so amazing for the others. And then also the wealthy families who are also alone a little bit and isolated, to be in an environment, they're listening to this in their car, on the way to work, wherever, to uplift them, encourage them, and to keep them on their vision. And some now will go and create an investment policy statement just because they heard what you said.
Yeah,
And
I hope
even
so.
wrote it down, the family charter, like you said, that was a really, really good one. So
Yeah.
yeah.
Awesome. No, I'm looking forward to it. I think we'll be, selfishly speaking, I think it's going to be great for me just to learn from all these other families. But I think, we will definitely put out some great educational pieces. And obviously, thank you to you for creating this platform.
No worries. Okay, Shuvam, we'll see you on the next one.
Awesome. Thanks, buddy. Have a great night.
You too.
Take care.
Hey, what's wrong? Bro, I'm stressed out. I'm running my business. I've got to serve my customers, but I need more customers coming in. I can't keep relying on word of mouth. Why don't you just use ETS Rabasha Media? Who? Well, with AI now, what they do is they go in, get your perfect clients, bring them in front of you. So all I got to do is run my business and he brings me opportunities. Think about it. You speak to 3,000 of your ideal customers, convert 1% of that 3,000. That's 30 people. 30 people in a room with you. Can you convert that? Of course I'll close them. I'm good at what I do. I just don't have time to be going and looking for my perfect client. Focus on what you love doing and let them bring you customers. When you win, they win, commission, cha-ching.
Sujira Rubasha, huh?
Yeah, Sujira Rubasha. Go and Google them, man. Come on, take it to the bank.
If you really enjoyed this video, make sure to click here, and I'm sure you're gonna love that one.